Hi everyone, Happy New Year, as this is my first video in 2025, so let's go over my bullish and bearish Elliott wave scenarios on Bitcoin. In this video, I will cover 4 different 4-hour time frame Elliott wave scenarios, which may sound like a lot, but at the end of the video, once we start talking about the probabilities and the polylines, I'll make sure to simplify it so that you know exactly what to look out for. Starting with the first scenario, which is a diagonal counted as a wave 1, 2, 3, 4, look for one more low in 5, and then a bounce towards the upside. In this particular case, we have an invalidation at around 99k and also an invalidation at 89.1k. If price moves to the downside and does touch 89.1k, then we have to keep in mind a deeper retracement to the downside, which looks like this: a 5-wave structure in A, WXY in B, and then a deeper retracement to the downside in wave C, where the common target area for your wave C is between 83.6k and 77.6k. After wave C, we then look for a bounce and a move back towards the upside. The third scenario here on my chart is also a zigzag, counted as a wave A, B, C, but in this case, your wave B is counted as a flat. So we have a 5-wave structure in A, then we have a 3-wave A, 3-wave B, and we look for a 5-wave C to the upside, preferably taking out the high of wave A, which is most common at 99.9k. And then after your B, we want to see a 5-wave impulsive structure to the downside in a wave C, taking out this low again at around 91k. Now, what is important in this scenario, however, is time. So you can see that I have 2 vertical lines on my chart, and these are fib times taken from the start to the end of wave A. The moment a price is moving beyond the 5 fib time, it starts to really reduce probabilities for a wave B, because your wave B is becoming very long compared to your wave A. And the 5 fib time here is sitting on Saturday, the 4th of January 2025 at 1 p.m. Central European Time. Moving beyond the 6 fib time would reduce the probabilities even more. Now, this is of course a fib time comparing this as your wave A with this as your wave B, not taking into account the possibility of all of this being a potential single structure, which then we have to count as a wave W. You look for an X and a Y. It is quite simply not yet relevant, right? Only if price is going to move beyond the 5 and 6 fib time do we potentially look for a change in wave A, but at the moment that is not yet necessary. If we then look at the final scenario, which is your most bullish scenario, we have a finished corrective structure, either an ABC or a WXY. Doesn't really matter, because in both of the cases it is not easy to count a finished corrective structure at this particular low. Now, I removed the lower time frame counts that I have, but if I explain it in a nutshell, if we want to count this as a wave A, B, and a wave C, then your wave C did reach the minimum target, which is taking out the low of A, but it is incredibly short. A rare target for C is the 618, which, as you can see, is not touched. Also, this wave C has to then be some sort of a diagonal, but trying to count a good solid diagonal in here is incredibly tricky as well, as some of the rules and guidelines are not nicely respected. If we then look at a WXY, we would count a double zigzag, and also here, double zigzag, wave Y. The low is taken of wave W, so the minimum target is reached. However, preferably in a double zigzag, you also like to see wave Y taking out the 618 as a minimum, which didn't happen. Now, in a double zigzag, you would need to count this as a wave A, B, and then a 1, 2, 3, 4, 5 in C. That of course means that your wave C is incredibly long compared to your wave A. It is longer than the 1.618 trend-based fib extension. And generally, once you pass a 1.618, the probabilities decrease for a wave C and increase for an impulsive structure. And also, if we do want to count a zigzag here to the downside in a wave Y, you would need to count this as a wave A, B, and then some sort of a diagonalish structure here in a wave C. The issue here is a bit that your wave 5 is longer than your wave 3, which isn't ideal. So then you have to think about expanding diagonals, but expanding diagonals are very rare. So it's not an ideal count on the lower time frames. However, the other scenarios look for price to take out the low, and you always need an alternative scenario, which means a bullish scenario in this case. And this is your bullish scenario, a finished three-wave corrective structure, and you quite simply look for continuation towards the upside. Now locally, we don't have to count a few 1-2s here, but the latest 1-2 would be to have a wave 1 in blue, look for 2, and price moves towards the upside, continues impulsively. Now the common target for a wave 2 is the blue box here between 95.2k and 93.8k, taken from this low here to the high on the chart. The 382 is a less common target at 95.8k, and you don't want to hit the 886 for a wave 2. That would be a bit of an issue at 93.3k. Not a hard invalidation, but it is not something that you like to see. And of course here we do look for impulsive continuation, so what is very important is price takes out the highs, and we want to see volume increase as it moves towards the upside. Now at the moment, the probabilities are difficult to give to, or the highest probabilities are difficult to give to this scenario. It only increases in probabilities if we can take out this high and continuously form three-wave corrective retracements as price is moving to the upside. So as time passes, it might become a higher probability scenario. It's quite simply not yet. Looking at the CVD divergences, this move towards the upside here was supported nicely with quite big bullish CVD divergences, bullish market structure, bullish CVDs. These have then a priority compared to the bearish CVD divergences, which nicely got invalidated. Now locally here, we had a bit of bearish CVDs while hitting resistance. We touched the previous month naked point of control. You can see the white box here on the chart. It was an area of resistance that we were looking for. A bit of bearish CVDs played out, but then again, once more bullish CVDs, which is quite interesting. I don't really enjoy going against the bullish CVDs unless more locally we start to form more bearish CVD divergences as price is falling. So we only had one bearish CVD, but if market structure locally on the right side here of the recent high turns bearish and we create lower lows and lower highs with additional bearish CVDs, that is the moment that I start to get interested myself. Now then, looking at the news, as we do have some news today, Friday here, January 3rd, 4 p.m. Central European time, so make sure you trade safe, can increase the volatility on the chart. And if we then look at the probabilities and the polylines, then purely from an Elliott wave point of view, the probabilities at the moment would still be higher for the correction to continue, with on the number 2 spot a finished corrective structure and price to continue to the upside following the green line. Now for price to, however, take out this low, it needs to create a top, and then the move down has to be an impulsive structure, not a corrective structure. And this is what is very, very important. For the blue line, for the pink line, and even for the red line, you need to create a high and then see a 5-wave impulsive structure to the downside to at least open the door for a bigger retracement, which is what you look for in blue, pink, and red. The moment you create a high, and every retracement you get is a 3-wave structure, so you move up, you get a zigzag, a flat, or something else, a 3-wave corrective structure WXY, and you then move back up, the probabilities are higher to take out the high, and you're going to be looking for upside. And if this happens every time, then of course you look for up and up and up, right? So if you have this 3-wave structure, you look for up, 3-wave structure up. And this is something that you want to see for the green line to slowly but surely increase in probabilities. At the moment, from an Elliott wave point of view, we didn't yet hit the invalidation for blue, which is 99k. The pink line would also decrease in probabilities if you hit 99 to 100k. right? But even after you hit 99 to 100K, for the green line to increase in probabilities even more than the corrective probabilities for a continuation of this range, you need every range after a new high is made to be a three-wave structure. So that is of course something that we will look for here on YouTube with all the videos I make. Now I also added a personal feeling section here, which I don't often do, but let me just read it. So I'm not yet fully convinced that the top over here is in and we look for an impulsive move to the downside. I would need more information to increase probabilities for that move down. The move up so far from 91K is tricky to count as a three-waver, which is necessary for a diagonal, so that just plays in my mind. The bullish CVDs, right, that we had with every retracement as price moved to the upside here is something that catches my eye, and I initially don't enjoy going against those bullish CVDs, meaning shorting into bullish CVDs, right? Unless locally more weakness is going to show. And for example, what I then like to see is local bearish CVDs keep building as market structure continues to be bearish. And if we continue to have a bearish market structure with bearish CVDs as price is moving to the downside, that is the moment where I'm like, hey, this is interesting, right? Now I might consider being part of that move towards the downside. So that's something that I keep an eye on, right? Now I prefer to also keep an eye on more local price action and observe if the new retracements slash ranges are three-wave structures or five-wave structures, right? If it is a three-wave structure, the probabilities are higher for price to move towards the upside. So this is basically a summary of also what I look for besides the Elliott wave probabilities, like purely from an Elliott wave point of view, probabilities are higher for the correction to continue instead of the green line, which is the bullish scenario, but the 15-minute and 1 hour ranges that form are very important for both of these scenarios. That's basically what I try to explain. If you get a five-wave structure down, we could look for blue, pink, and red. If you constantly get three-wave structures down, then slowly but surely green increases in probabilities. I hope that this video was helpful or valuable to you. Please check out the CVD indicator video, the best indicator out there in my opinion, or the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.